Good morning, everyone. This is Maddern Money Talk. We have a very special guest this morning, Bryce Mitchelson. He's not only incredibly competent in real estate, I'd like to consider him a friend, a very fine tennis player, played for Victoria, member of Kooyong. We often practice together, so a very informative session coming ahead of us. Quick background on Bryce. Mum and Dad were both real estate agents, so property's in his bloodline. He's got an excellent property DNA. 2 bachelor's degrees, one in economics accounting, and then he decided further that he would study property specifically and became a valuer. Later on, he then did a graduate diploma from the old Securities Institute in finance and investment. So eminently qualified, great background, great experience. So welcome, Bryce.
Thank you, Dennis. A pleasure to be here. And thank you for that kind introduction. It's way too positive. So thank you.
Good. Look, beginning with the first question, the great perennial question, property versus shares. Now, a lot has been said over the decades about is one superior to the other? Are they equal? If there were a foot race, who do you think would win? And would it be over the short, medium, longer term? And the issues of diversification, can you just chat about those in your response? And of course, the importance of overall goal setting. So there's a good question to get started.
Oh, well, what a big topic to start with. The shares versus obviously the answer is both, right? In a diversified portfolio, You've got to have both of those things. Properties are probably a lot more difficult to get the right sort of exposures to, and it's a bit more. There's nuances to property, whereas obviously with equities and shares, large choice, a lot more liquidity in that market in terms of and you can and small lumps of money that you can invest in that sort of thing. So, but I think it depends on the client, right? It depends on the investor, and what their needs and their goals are in life. And
let me just interrupt and say, let's take a typical Maddern client. They're a retail client, albeit they might be sophisticated or wholesale. We treat them as retail for compliance purposes. At the end of the day, they want to be able to live a nice life, and that includes sending their children to the good schools, living in a good suburb, and most importantly in retirement, having what we call a luscious retirement. So, Bryce, continue your answer, but with that in mind, if that's okay.
Sure, yeah. Well, obviously, we all want to be financially independent when we reach retirement. I've retired over the last few years, so I'm in that sort of stage of my life now myself personally. But property, look, property is a very interesting asset class. It's one of the major asset classes. When you look at a lot of the wealth which has been generated by many of the top 200 wealthy people here in Australia, they've all got property in their portfolio. There's a lot more technology obviously coming into it these days, but there's a lot of property there. And property has various dimensions to it all. You can have listed property, you can have unlisted property, you can have direct property. They're all different. And then you have obviously different types of property, and you have locational aspects to it all. You have obviously the properties are leased, they're investment properties, so the lease structure and the tenant becomes very, very important. So, and obviously, generally, if from a direct perspective, the lumps of money you need to put into a quality property are quite large. So that normally rules out a lot of people. If you need to put a minimum, I don't know, a couple of million, $3 million into property, you're going to be very skewed. If you've got a portfolio, maybe it's five, you're quite wealthy, you've got a $5 or $6 million portfolio, you're still going to be very heavily weighted towards direct property. And as you get older, I think you need diversification in your portfolio. So it might be fine when you're young, but as you get older, I think you need a bit more diversification. And probably buying direct property becomes a bit more difficult, particularly if you own your own house anyway. I don't regard your house as an investment. I think that's something you live in, and it's sort of more a personal asset. But when it comes to investing, you need to have some diversification. And this is obviously where shares is obviously much easier to deal with because it's a broader portfolio. You've got a lot more choice and more liquidity. So property has its own problems and quite difficult, I'd imagine, for a lot of your clients, other than if you're, say, a doctor and you own your own premises, it might be your medical practice or something like that, or you're a financial planner and you own your own building. That's probably got a bit different. But if you're trying to get property exposure in your portfolio, it's quite difficult. And I wouldn't say, a lot of people think of residential, obviously buying a flat or a house for investment purposes, but residential property is actually not a good investment to have really at the end of the day. The yields are very low. They've got all the tenancy legislation. So when you actually look at the returns from residential real estate, they tend to be a lot lower than what you'd otherwise have in commercial property. And when you look at things like shopping centres or even I've done a bit of childcare and healthcare. Those asset classes tend to sort of give you better quality returns, but it depends. So when you start looking at those larger properties, the only thing you can look at is a more unitised type structure, whether it be an unlisted format or be in a listed property trust. And as I say, but you can go, and if you look at the listed property trusts, well, then the correlation, how those investments move, are very correlate highly to the equities market. So, but it is in between. It's not quite the same. The volatility tends to be a little less with listed property, but you then get access to quality properties. I think at the moment also, if you look at where properties trusts have been over the last few years, they've been trading at discounts to the underlying net tangible asset value of those trusts. So it actually hasn't been a bad place. And listed property trusts have actually performed very, very well over the last 12 months. So it's a complex question you're asking, and it's not only about the investment exposure, it's all about the underlying structures. Yes. And if you're in a unitised structure, you have fees, managers charging you fees. And you just have to be careful of a lot of there's conflicts of interest and fee structures, gearing structures. Do you have it geared up to 50, 60%, or do you have it geared at 30, 40%, which is a bit more comfortable? And it all depends on the investor. This is where it gets back to, at the end of the day, what is the investor comfortable in what they understand and know, and so they can sleep at night too. I think of it my own way. I only like investing in things that I sort of understand. Yes. Whenever I've invested something outside my sort of sphere of expertise, if you like, it's always been a bit of a disaster one way or another. And so I tend to avoid that now, and I tend to only stick to what I know. That's been one of the lessons I've learned over time.
Okay. No, look, that's an excellent response. And you've raised a number of questions, but let me consolidate just a few points I think you've made. In terms of the foot race between property and shares, there is no winner. That they have their fitness for purpose. There's a timing issue, and over the years, each has outperformed the other, and vice versa. So you probably need, for diversification purposes, both. You've also spoken a lot about property, and one of your comments was a little surprising, possibly for our listeners, which was that residential is not a good investment because many clients, it's what they know. They've bought a house. They know that. They may be because their brother or sister have done an investment property. So I find that a lot of our clients tilt towards residential all the time. But you've made the comment that with the various residential tenancy tribunal issues with, again, low yields, because if you get a good tenant, you don't want to lose them, so you do that.
Yep.
But there is also exceptional capital growth that's taken place. And Brisbane right now, is, as I understand it, is booming.
Yes.
Melbourne may be flattening a bit, but Brisbane and others boom. But you've mentioned that maybe commercial, and it's not just factory, office and warehouse, but you've also mentioned childcare and different ones. So you're saying for somebody that wants to invest in property as a general term, that they should break it down and look at the specific elements. So residential has certain features and benefits and so forth, commercial, factory, office, warehouse, but you can also break it down with hospitals, with childcare, etc. Do you want to talk a little bit more about that for the retail investor? What would they need to know? Is there a certain yield that they look for? When we invest a client into shares, we talk about, does the share 100% frank? Is there a good income stream? What's the price to earnings ratio? And we don't want that over, say, 11%, say. And again, what's the capital growth prognosis? And there we use complicated research from, various top research houses. How would somebody looking to put their foot in the water with respect to property, what sort of things would they look at? Should they start with a residential, just blood themselves to a little bit, and then move to more sexy investment parts of property? Or what do you think?
Yeah, well, it's a very good question, and again, it gets back to what the investor's comfortable with at the end of the day. And obviously, if you buy a residential property, I can understand why people they can control it. You can go borrow on it. And you can sort of you can decide what you want to do. The problem with these unitised structures is you're handing your money over to a
Now,
fund
when you're
manager.
talking about a unitised structure, you're talking really about real estate investment trusts, or what we now know as managed funds.
Correct.
They are formed into units. You can buy 10 units and so forth. You don't have to put together $3 million to buy a childcare centre. You can buy units in a series of childcare centres if you wish. Yeah.
Correct, and this is the issue. For a shopping centre for $300 million, very, very hard for an individual to go buy a shopping unless you're super, super wealthy.
Yes.
Not many of us, though, those sort of people are around. But so what's happened over time is the property market, the commercial property market's been unitised. It started with the listed property trust and got unitised into property trust, and they got listed on the stock exchange. Right. And then there's another, an unlisted market, which is probably just as large as the listed market. And a lot of the wholesale superannuation funds invest in these wholesale property trusts. And these are all what's called a tax flow-through vehicles. Yeah. So the income you receive are all pre-tax, and you get taxed on your distributions in your tax return effectively. So this is where property being so lumpy. Really, the reality is if you want to invest in commercial property, you have to do it through a unitised structure. Right. There's no other option, really. Right. Now, obviously,
so that would be a real estate investment trust.
That would be a real estate investment trust. And the problem with these unlisted property trusts is that there's been bad experiences through the GFC where obviously when the property market dropped, this is back in about 2009, 2010, the property market dropped about 20%. Yes. And then the listed property trust market, if you look at the index today is still 25% below. The listed property trust index is still 25% below what it was in 2007. So you can sort of see the damage done through that GFC because all the trusts had to recapitalise and it sort of diluted those returns down. But so you need to be very, very careful and selective. All the problems, the problem you have in the property market, when you invest in property, your biggest issue is having too much debt. And this is what, if you haven't got the equity, you borrow a lot of money, you might borrow 50, 60%, and you might do this even on a residential property. But you run the risk that if the property drops 10, 15, 20%, you breach your, what's called the LVR, loan to value covenants, and the bank takes control. And the bank takes control, they sell the property on you at the worst possible moment in life, at the bottom of the cycle, and you lose all your money. And so the lesson is, be very, very careful of debt. Yeah. And as you get older, your risk tolerances, in my view, come down a few notches, and therefore you want to be very careful of debt. And so a lot of these structures, you've got to be very careful. What is the gearing? Is it 20, 30%, or is it 50 or 60%? And are you comfortable with that sort of level of gearing? And I've done a little bit of investing personally into those sort of structures. And I think when you do have high gearing, you've actually got to put a bit of cash in reserve. For if a day comes along, they say, we've breached our covenant, we need to invest a bit more money to remedy the default. You can actually invest a bit more money back into the trust to fix the debt issue, and that way you don't have the bank taking control. Yes. And so you have to think about the plan B and plan C if something goes wrong. Right. And but I think for your average investor, the first place to look would probably be the listed property trust market because there's some good quality assets. Yes. It's been trading at discount. I know it's done quite well over the last 12 months, but it gives you a good yield. It might give you a 5 or 6% sort of income yield. And the reason you're investing in property, by the way, is not about the income yield, it's about the total return. Right. Property is all about a total return. You have your income and you have your capital growth. Yeah. And if you're investing because of the income, well, that's one thing. But really, when you're valuing the asset itself, the valuers, people looking at the value of the asset, it's all about the total return expectations. Yes. And then if you look at what are the key things that go into your thinking about from a valuation point of view, something like the 10-year bond rate, that's your risk-free rate, and you have a margin above your 10-year bond rate. So if you're the 10-year bond rate at the moment, something like about 4.3%, and the total return on commercial property at the moment, assuming it's all stable, is probably around about sort of 7.5 to 8% total return. Yeah. And they can be geared. You borrow money at the moment at around about sort of 6%. So if you've got an income yield which is higher than your cost of debt, it's positively geared. And I'd suggest to anyone investing in property, never borrow money on a property which is yielding you below your cost of debt. It's a negative gearing thing. It used to be a big thing for tax purposes, and it's obviously a big thing for residential property. But reality is when your income's not even covering your cost, you're relying on capital growth. Yes. And that can be dangerous. Yes. That can be dangerous.
There's I guess a lot of changes taking place in society as well. You've got the Victorian government, for example, are not asking many of their employees to come back to work. So in the city, there's office blocks arguably half empty, and in St Kilda Road, the same scenario.
Yep.
You've also got a lot more buying of goods online. I buy all my shirts online. I know my sizes and all that sort of stuff. So I haven't been to Chadstone or Doncaster Shopping Town in years now. I have no desire to see it as an entertainment thing to go walking up and down corridors, looking at shops and so forth. So how about some of these societal changes? So does that sort of mean we move away from office a bit? Does that mean we move away from shopping centres a bit more? Or do you think that they'll bounce back? Because I can't see, I see even companies now starting to say, oh, we're going to do a 4-day work week. We're going to offer working from home, all of these sorts of things. So how do you think if somebody is contemplating and listening to this podcast and they say, okay, Bryce makes a lot of sense, what sort of REITs should we be looking at? Aged care REITs? Should we be looking at childcare REITs? Should we be looking at what sort of REITs might for the future
be a good place to invest? Yeah. Well, I think you're right. The COVID pandemic sort of taught us a lot of lessons. We had the CBDs close, we had shopping centres close, and the fundamental thing in property is if you're not getting an income stream, what's the value of the asset? It's the value of the asset's worth its future income streams. So if you're not getting much of an income stream, then the value of the asset's depreciated quite significantly. And I think we're seeing that in St Kilda Road at the moment. I think the vacancy rate for office buildings in St Kilda Road's hit something like 30%. We haven't seen those sort of vacancy rates since the early 90s. Post that GFC period back in the late 80s. Big issues, big problems, but where you see this volatility, you also create opportunities, and this is where the thinking at the moment in the office market is maybe values have dropped 15 to 20% already in office buildings, and there's a few issues going on, but has it dropped to a point yet where it starts being of value? And it's the same thing with shares. Shares drop a certain point, they start being of value, and then you invest and you sort of make money. I guess from an office building perspective, I'm a little bit sceptical. We've got a lot of talk now about artificial intelligence, what that means for the average office worker, and whether you'll have programs doing the work of a lot of office workers. Do we need all the office space? A lot of the big occupiers in the CBD, the banks, some of the big financial institutions, what are they doing? A lot of these guys are shedding staff at the moment because they're introducing these new automated systems which can do compliance, can do customer services, answering, responding to queries and complaints. It seems hard to have an artificial intelligence, but that seems to be where we're going. And if that's the case, then maybe how much office space we need, maybe we've got too much office space now, and we're seeing all the sort of latent vacancy sort of come through. And there's been a gravitation towards the very high-end quality office buildings. So if you're at 101 Collins Street, all the tenants want to be there. They don't want to be down in the back box somewhere of, La Trobe Street. And if you're stuck with an office building in La Trobe Street, well, that's going to lose a lot more value potentially than something in Collins Street. So it's all about quality at the moment. Right. When we talk about quality assets, where the tenants want to be, I think when you think about shopping centres, it's been a bit of a different story. We did see a move to online. The online percentage of online sales now about 12% here in Australia. It's been actually moving, went higher during the pandemic, and it's actually come back. But what a lot of the retailers are doing is they're using both channels. They've both got the store and they've got their online. And what the shopping centre owners are having to do is provide for click and collect, it's called. Right. So you order online, but you can go to the store and pick it up. Okay. And so quite a big swing towards click and collect. And really going forward over the next 10 years, if your shopping centre can't provide click and collect to your retailers, and retailers are your tenants paying the money, and they're your true customer as an investor, then you've got problems. So you've got to look at the property and say, well, okay, previously everyone walked this way in, and this is where where the goods came at the back of the shopping centre. You need to find a way that people can very quickly pull up, get their stuff, and then drive away again. And I think you mentioned about Chadstone previously. Chadstone's a bit of a nightmare. But the thing about Chadstone, what it does, it provides, if you want high-end a certain retail good, that's where you go to get it because you can't get it anywhere else. Apple have their store there, nowhere else. So, so it's about the quality, the range, convenience, and price. That's what really drives retail, and retail's actually performed pretty well over the last couple of years. Post pandemic, shopping centres got hit very hard from a value perspective. We saw yields blow out to 7, 8, 9% yields, and that's actually I've been involved over the last couple of years. Actually, being involved in buying shopping centres, I saw them as very good investments. And they've done quite well, and they're still good. You still buy a good quality shopping centre now on 6.5%, 7%. And you've got to remember these shopping centres have all the infrastructure around them. They have all the buses come there. They have all the infrastructure, and you can't replace that infrastructure if you're trying to be convenient. And I think when you think about property, one of the things to look for, and whether it be residential or whatever property you're looking for, it's about the infrastructure around you. It's the linkages of the property. It's a spatial. Think of it as the spatial dimensions of property, and its relationship to things around it. And the infrastructure is obviously very critical. If it's a residential property, it might be how close it is to a hospital. It's one of the reasons why St Kilda Road did very well from a residential point of view. Close proximity to the Alfred Hospital, and which has become more important. So those elements become much more important. And if you're looking for where growth might come from when you buy a property,
yes,
it's how those linkages might change over time. Right. And here in Melbourne, you've seen over the last couple of years, we've got this big issue about housing. We've got a shortage of housing at the moment, and the government's trying to solve this housing crisis because immigration's been quite strong. It's actually we had some population move out of the sort of migrated to the north, the better weather during the pandemic, but we're now seeing a lot more population growth here in Melbourne, and it's, if anything, it's put a lot of stress on the infrastructure. You can see it on the roads. And not only that, but we've got a financial situation Daniel Andrews has left us in, which is not too happy, where we're getting potholes in the roads not being repaired, that sort of thing. So, but we have this population growth, and I think one of the other drivers of property is population growth. Yes. It's like any economics. Fundamental economic issue where you have population growth, you'll have growth above inflation.
Yes.
And that's similar to how retail sales. You try to find a location where the growth in the population around the shopping centre is above normal, and therefore it's inflation plus your population growth, which actually gives you good growth. You might get 5 or 6% growth, and then you'll have capital gains tax, capital gains on top of that. So property is very, very specific. Probably your listeners can't get into all the nuances around those sorts of things, but what to look for is good quality property, and hopefully at the right price. It's all about being at the right price, and the listed property trust market there. There's a bit of money flowing back. That's why the index has been raising up over the last sort of 12 months. I think the general equities market's been very strong. As you'd be aware, and I think that's part of the problem in today's investment climate is this correlation between the markets, and how do you get diversification into your portfolio? And it's one of the benefits of property because typically most portfolios are pretty heavy overweight to equities, might be international shares, that sort of thing, and trying to get sort of diversification in portfolios is quite difficult. Yes. And property's a good solution, but it has its issues.
In shares, there's a couple of comments to make. One is that there are certain growth positions, and we suggest that for clients in shares, the food, Australia should feed Asia. There's infrastructure. We're a continent. We're not a country. We're a continent. We need fast trains, bridges, railroads, ports. We need massive amounts of stuff. And of course, aged care. You get new hip, new knee, ACE inhibitors to lower blood pressure, statins to lower cholesterol. It's hard to die these days, so it's very, very difficult. So we have certain themes now. We've narrowed down for property, but we've kept it towards Australia. Now, again, there's another old saying that as bronzed Anzacs as we are, Australia represents about 3 or 4% of the market cap stock market of the world. We're the equivalent of Vanuatu on a worldwide stage.
Scale, yeah.
Okay, the Americans, whether we like them or not, whether it's Camilla or whether it's Donald, the reality is they're 58% of the stock market of the world. If you're not in the American market, you're really missing out on a lot of opportunity. Can the same be said for global property? I mean, Melbourne and Chadstone, God bless their little cotton socks, but, how does it compare to Manhattan and the City of London, and how does it compare with Mayfair and Surrey, and how does it compare with, again, Connecticut and these sorts of things, let alone the up-and-comers, Prague, the Paris of the East. We have a friend in common, a tennis mate, that's got a nice little apartment in Budapest, and he leaves his house in Melbourne and pops across there for 2 months of the year and in Central Europe, and he then squirts all around the place. So is global property also something in a REIT, unitised trust structure, or should we just try and stick with Australian property, do you think? Because we know it.
Yeah. Well, I think you put the nail on the head. You hit on the head there in the sense that it depends on your motivations, right? Is it about investing, or is it about having a holiday place somewhere you can go visit for a while? If it's about investing, then I always believe you go with a specialist. If you don't know much about US property, you have to invest with someone who does. It's the same here in Australia, where if you're talking about an office manager, you got to invest. Particularly if you're through these unitised structures, go with a specialist manager who actually knows what they're doing. Hopefully. And hopefully they know what they're doing, and you trust their judgment, because there's no possible way, even myself as a property expert, that I can tell you everything going on in the US. I've spent time in the US and invested in retail shopping centres in the US and what have you, but it's fraught with danger getting outside your own backyard and trying to understand something that you're not really that familiar with. And it takes time to sort of learn markets. And I guess, so the short answer is, you've got to be comfortable. I think investing in property in the US comes with a whole heap of tax. You know this from share investing, all the tax stuff, compliance work that comes with investing in the US. So I've actually found it too difficult, to be honest. And Australia's by far a big enough place for me to be investing in property. There's lots of choices and lots of things to be doing. And I've just found that a lot simpler for me, and I can get my head around what's happening in the office market, and I get my head around the retail market, and I'm talking about other asset classes. I spent I set up a listed REIT investing in childcare and healthcare. That was my specialty, and childcare, great properties. These are long leases. Funded by the government. The Labor government's trying to bring in universal childcare at the moment, so they actually want to pay for all your childcare. Which means that effectively your income stream is being effectively supported by the government, but you'll have a 15-20 year lease, and you can some of the childcare properties that I've bought over the years have been fantastic. Next to a primary school, it's all integrated in the community. They're just fantastic investments. Healthcare, private hospitals, obviously a big area. They've had difficulties in more recent times.
Yeah, because Ramsay, as we sit here, is down.
Yeah, the problem has been the profitability of the operators has come off. Ramsay's a big organisation. They have exposure around the world, but many of the private hospitals here in Australia have actually been losing money because of the way the insurance system works and what have you, and the way the government has set us up here. So there's a group, I'm just trying to think of their name off the top of my head, who privatised a few years ago, and they are going through. They borrowed, private equity bought the business, and fairly high levels of debt, red flag, and they're now having trouble paying that interest bill. The profitability's come off a little bit, but the government can't let the healthcare sector go down. It's one of these essential services. Yeah.
Particularly the baby boomers are coming through as well.
Oh, well, the aged care.
So the aged care as well. Yeah. So you've got healthcare, aged care, and the connection between those, and then you've got the young ones as we have a larger immigration amount.
Just come back to this.
No, you're on a roll.
Just coming back to healthcare. One of the issues with we're all getting older, obviously, but the nature of the operations are changing. The technology's changing now. Where in the old days you'd go into hospital and you'd stay there for 3 or 4 days. Now you have these day procedures, and you end up at home, and they look after you in your home. Yeah. And it's obviously a much more efficient way to manage healthcare. So that's what's that trend is moving that way. So a lot of these private hospitals got these beds, and no one they're in the beds. So and that's a problem. And the private health insurers are obviously trying to push people out of the hospitals, and trying to get the cost of healthcare down. Yep.
So you think that maybe aged care connected to healthcare and sort of childcare are probably pretty good fields to invest in. Now, again, this is not specific advice, and you're not here, and you don't know the circumstances of any people listening, so it's a general comment. But you think that is likely to be a good
well, it's certainly
asset class to move forward.
Certainly tailwinds. The issue is that when we talk about aged care, what are we really talking about? Well, there's different types of aged care. There's nursing homes, and nursing homes are really now becoming the last 18 months of your life. You know, let's get realistic. That's really becoming. No one really wants to be in a nursing home if they don't have to be. You only go there when you have to be, when you need the 24-hour care that you need, and it's very expensive. Government's just changed the rules where they're effectively getting individuals. The wealthier you are, the more you pay. To pay for all that. The aged care sector went through incredible problems during the pandemic, and we saw a number of, it was a situation where, COVID, obviously the virus got into residents got the virus. Staff didn't want to get the virus, so the staff wouldn't turn up, so there was no one enough to look after the residents. The residents got very sick. Government, so we had this problem of where do you get the staff, sick residents, and you had to take some of those residents, put them in hospitals. Some of the residents died in the process. So it was a terrible, terrible scenario in that sense. And aged care is still suffering from some of those issues. But I sort of know personally, it's only if I get dementia, or it's only if I can't look after myself, it will be the point that I end up in sort of aged care eventually, and we'll probably all end up in some form there. And so it's a critical service. And obviously, as we all get older, the question is whether healthcare will get better and whether they can extend our quality of life in some ways. And we're both a bit of a fitness sort of playing a bit of tennis and what have you. So we're relatively fit people, and there has been a bit of a switch. I can just feel it around. People are much more conscious of their health these days. We're drinking less alcohol.
Yes.
We're just a lot more conscious. We're getting annual checkups. A few years ago that wasn't happening. Everyone now generally gets a pretty much an annual checkup. So, and there's more tests you can do to work out what's wrong with you. So, so there's a bit more preventative care going on. So the question is, we end up living a bit older, and there might be a period where we actually don't need as much health care for a little while until we get a bit older, and then we'll need a lot of it. And I think that point's somewhere down the track. And so therefore the demand will be very, very high, and it'll probably be a point where there won't be enough supply of nursing homes. The other thing about aged care, if you go back a stage earlier, there's retirement villages. And retirement villages have been in the papers just more recently. There's been been getting a bad rap. They charge these deferred management fees. Some people see them as a bit of a rip-off. What are you getting? But you're having to pay for these community facilities. You get this bowling club and you get a nice community centre and what have you. But really, at the end of the day, do we really want that? I don't know. Everyone's different. But I'm not quite sure whether retirement villages are the solution. I don't think it will be one of those things that suits me. But I know here in Melbourne, just down the road, the Menzies. It's a retirement apartment complex which has sort of a bit more care. I could sort of see potentially that might be suitable at some stage. All gets back to the individual and how much care they need. And the other big thing is obviously dementia's being. When you start, your mind starts being affected. Very, very hard to be living independently when that's sort of going on. So there's no doubt. Somewhere down the track, we're going to need a lot more of that service. Whether we can get it in the home, the government's been big on home care and trying to support home care but that's really for maybe it's helping with cleaning and maintenance, those sorts of things. I think once your mind starts going, it's a different story, and I think you need 24 sort of monitoring. So I think it's a big area, but I'm not quite sure whether the type of accommodation we have in aged care is really suitable for where we might want down the track somewhere. And I think that's one of the big questions, and how it's all funded.
Okay. While your mind is still sound, Bryce, the tax structures, I mean, we have a business here. Our business model is an integrated business between advice and accounting. And so we have the view that we don't mind if a client comes in and says, look, I want 10 properties before I'm 60, and I want passive income rolling in like the Mississippi River, and I just want to take that. And that is their opinion. Whether they want diversification is a secondary issue. And so our accounting division would then say, okay, but, how should you buy them? Should you buy it in your name, the male name, maybe the female name, the couple name, a family trust, a proprietary limited, a self-managed super fund maybe? Do you want to comment on the importance and how key that is with tax structures? Because from our business perspective, we don't have to take being 100% independent, Section 923A of the Corporations Act. we don't have to take you down the garden path. If you want 10 properties before you're 60, if you want gold bullion, if you want Don Bradman's cricket bat signed, and that's an appreciating asset. If you want diamonds, the 4 Cs and above 5 carats, and that's an appreciating asset in your mind, and they're flawless. Again, whatever it may be. So how important when you do contemplate, again, these certain parts of property or diversification, we often see the tax decision being the primary decision, and then the secondary decision being factory, office, warehouse, residential, REIT,
flexibility,
this, that, and the
yep,
other.
yep.
Would you agree with that?
Oh, definitely. Look, Dennis, the getting advice early in these sorts of things is absolutely critical. Investing is all about compound interest. The magic of compound interest over the years. But one of the leakages you have is tax. And if you have it in your personal name, or you're on if you're still working and your marginal tax rate's pretty high, or should it be in your super fund? Super funds, got the benefit of these low tax rates. You have a self-managed super fund, or even just it being in one of the industry funds. But you're not likely to put. The industry funds aren't going to allow you to put property in. You can only do direct property, like a house or a residential property or something, into a self-managed super fund. Yeah. And so but to have the self-managed super fund, you need to be talking to a financial advisor to tell you how to set all that up properly. But there's big benefits, and the big leakage is tax. And the problem I've spoken to a number of friends over the years. The problem I've seen time they get the advice too late. They go do something and they then find they've got too much tax, they're paying too much tax, or something's going on, or they've got to sell something or do something, and there's no flexibility, or they're paying too much tax. And with a bit of simple advice, much earlier in the piece, before they did it all, they could have saved themselves a lot of problems.
Look, I'd like to reinforce that. We've had some clients who've come in and a bit of a chest puff. I own 10 properties. And they've just come to us recently, and they've already purchased them. And the first thing I'll say to them, well, how do you own them? And they'll say, well, they're in my name. And I'll say, I bet a mortgage broker set that up for you. Oh, yes. Because the mortgage broker said, give me your fortnight's pay slip, give me your grip certificate, bing, bang, sting, I'll have pre-approval for you in 48 hours. But many mortgage brokers, not all, sometimes don't want to mess with trust deeds of family trusts and or SMSFs and so forth. There's not a lot of bank lenders now in the SMSF space, but there are funders that will fund it, and there's a different LVR for different things.
It's a bit of a minefield.
I say to them, you are going to meet a very good friend one day. He goes by the initials CGT. Right. And so that's an enormous problem. And they say, oh, well, I want to move it out of my name. And it becomes then a problem because you can't use residential property as a non-concessional into a super fund, et cetera, et cetera. So I'd like you to comment again, and I think you already have, on the absolute critical importance that before you start investing, get your tax structures right, and then you can sit back and whether it's gold bullion, blocks of land in Torquay, REITs, individual direct property, whether it's shares, managed funds, ETFs, exchange-traded funds, whatever you may go into, God bless you, but get your tax structures right. Would you agree with that?
I agree with it wholeheartedly. Getting that advice early, but also understanding what you're going to be investing into. Because, again, we talk about residential property. Here in Victoria, we've had this new land tax regime come into play, and people are getting hit with these huge land tax bills. So you imagine, the return profile on those properties has just completely been decimated. But if it was sitting in a self-managed super fund or sitting somewhere, maybe different, or maybe you just got rid of the thing. But you need to be very clear why investment's all about being very clear about what you're doing, the right structure, the right investment at the right point in the cycle, timing from a timing perspective, and then knowing how do we keep monitoring that investment? When do I sell it? When do I keep? You've got to keep monitoring these things and being active. Nothing worse than having a lazy investment portfolio, in my view, because you'll miss things, and when you miss things, you miss opportunities in that sense. So I think tax is very important, but I also think monitoring and keeping up to date and knowing, and tax laws are changing pretty regularly. There's a lot of talk. We've got a government, a federal election coming up in May. There's all this talk about CGT and about whether they remove this, the discount. Be ready for it. Be ready for it. I think what we're going to find over the next few years, we're going to get taxed more, not less. Yes. Government's out there spending lots of money on infrastructure, and property seems to be a a fair game to the government, to obviously targeting wealthy investors where they think they can raise the taxes. And we've seen this across the board in a number of different areas.
Well, someone's got to pay for NDIS, nuclear submarines, and the deficit from COVID and everything like that. So, look, before I get on to your tennis career, because that's an important part as well, you have a term that we've used in the past. You call it lazy cash. Would you like to just talk about the importance of utilisation of cash? Now, again, this has to be dealt with somebody's risk profile, their risk tolerance levels and all that, under the principles of diversification, connected to their goals. But if somebody just had a lot of cash sitting around, would you like to just talk about what you mean by your term lazy cash?
Lazy cash. I think a good story here. My wife's Italian, Sandra, and her family's Italian, and they literally put a lot of cash. He was a concreter and put a lot of cash under the bed. Yeah. And the problem with that is that, and it probably sat there for 10, 15 years, it missed out on this magic of compound interest. Investment, anyone who talks about in the investment world, it's all about compound interest and how that money grows over time. So the longer you're invested, the better off you are. And the earlier you start, the better off you are. But if you've got money sitting in cash and you've got inflation, so if you go back a couple of years ago, you're getting hardly anything on your cash. You're lucky to get 0.5% in the bank account, but you had inflation running at 5-6%. Well, that really meant you were going backwards. Your purchase power of your money was going backwards at 5 or 6%. So I can understand people wanting to be careful, conservative. Don't want to be, I want to be safe. I don't want to lose my money. But the last thing you want to do is leave it too much of your portfolio in cash. And when I say too much, obviously you want to have an emergency fund day. You want to be able to survive for 2 or 3 years if you don't have any income, but you don't want to have 40% of your portfolio or 30% of your portfolio even sitting in cash. It needs to be working for you. It needs to be making money for you. And even if you go into something relatively, you should be earning an 8, 9, 10% return. The magic number to aim for is 10%. If you aim for 10% total return, whether it be shares or property, you just try to obviously manage your portfolio to try and give you that sort of return. If you can do that, well, I think every 7 or 8 years your portfolio doubles in value.
Yes.
And I think it's one of the things, as I get older, I look at my money and say, gee, that's a fair bit of money. And it's probably not, if I go back to it, it's probably half what I think it is in terms of real value, because, even housing's, the growth in housing, my mother bought a property here in Gunaris, $20,000, I think it was, back in the 1970 sometime. It's now worth $2 million. It's gone from $20,000 to $2 million. It's the same property. Not giving you anything different, but the value has changed that much. And don't think you're wealthy, because it's only of much value of what use you get out of it. So it's the same with your investment pool. You got to think about the real purchasing power, and therefore, if you to look after yourself in retirement and to reach your goal in retirement, to be an independently retiree and not having to worry too much about your financial situation, you've got to have your money working for you.
Yes.
You just have to.
Yes.
And to do that, you've got to get advice and you've got to work out where to invest, but don't leave it sitting in cash too long.
Yes. No, look, that's a very, very good point. Now, let's talk a little bit more about you, all right? I've known you for a number of years and we practice together tennis. We have drills. We have very competitive drills, which are very good. Bryce, you've played for Victoria. You play all these ITF, International Tennis Federation tournaments. You travel all around Australia. You're contemplating even going overseas potentially for some tournaments. And your goal really is to play for Australia. You've played for Victoria. You've worn the little big V and the blue and white of Victoria, and you're keen to wear the green and gold. So your tennis career, you've developed that via goals, which is really the connection with investments. And I see a great similarity, because if you wanted to work on your backhand, you set a goal. If you wanted to put more topspin on your shots to keep the ball down, you work on your goal. If you want to improve your toss for the serve to get more consistency, again, you set a goal and you work at it. That's pretty much how you'd approach investing. But do talk about your tennis and how you see that comparing with your life, because I find that the tennis that I've had, people have often said to me, how did you study and do all the things? to sit in a library with a yellow highlighter and a Mars bar. You kidding me? It was simple to play with Irish skin in
Get some fresh air
35 degrees with burning heat and zinc cream on, with the wind blowing and the balls flat. Now that's and the guy cheating you, that's tough. So again, the importance of the correlation perhaps between athleticism and your pursuit to improve versus this attitude of improving and utilising cash better and so forth. Do you see a correlation between them?
Well, of course, and I think tennis is one of those things I really enjoy. It's a true enjoyment in life, and I love the idea of getting exercise and then having competitive spirit about and the whole thing. I played I started playing tennis when I was quite young and got coached by a fellow by the name of Ian Alkershaw when I was quite young and played tennis through my school years. But it got to the point where I had to study. I had to make the choice: tennis or study and study one. And so then many years, and you get into a family situation. And it was only a few years ago when I sort of semi-retired that I saw a good chance to get back into tennis and enjoy myself a little bit and travel and do all the things. But I've worked out pretty quickly that it's a bit of discipline involved in terms of getting your body right, your mind right, your shots right. Everything has to be working well. And as you get older, obviously injuries come into play too. So how you manage your body. But it's a very healthy thing to be doing.
Yes.
I see it's a very positive thing, and it sort of helps me with stress.
And it's sharpness of mind, and again, as you look at investments and so forth. So the correlation between what the ancient Greeks used to call mind, body, and soul is, again, I think, we need to work on all three in many respects.
Well, I think one of the things you learn, and whether it be whatever it is, you've got to put more effort in, right? It's not about just trying to do the job or just trying to get something done. If you want to be good at something, you have to work at it pretty hard, and it doesn't come overnight.
No.
It's something you have to work at, and it takes time. It's the same in business. You have to keep working. You have to learn, keep working through experience, through contacts, through knowledge. And I think tennis is the same way. And I've gone through a bit of a relearning curve, my tennis game over the last few years as I've sort of got more into competitive tennis. And it's like trying to break through a wall.
Yes.
And you're chipping away. But finally, you might get through. And I had a great win a couple of months ago. One of the higher ranked players, and whenever you beat a higher ranked player, it's a good day. And very, very pleased with myself on that day. Unfortunately, my next match, I got a bit of an injury, and it sort of didn't end well. But I was very, very happy with that match, and it's very satisfying to be able to sort of get out there and in that sort of competitive environment. And you've got to sort of say everyone's trying their best, everyone's trying their hardest, but how do you find that little edge?
Yeah.
What is it, and what is it about your game? What is it about you can do to win that next point? And it's a bit of thinking, discipline, keeping your mind under control, keeping the cool, calm, collected, but also trying to execute on it. And that's the lessons in life. It's the same life over. And but nothing happens just by osmosis.
Yes.
And you've got to work at it hard. And I think and that's why I've been working at a cup for a few years now. And but I've been doing reasonably well. And all the guys we're playing have played for years. They're all professionals and they're all coaches. I've never been a tennis coach myself, but so I feel like I'm coming from behind a little bit, but I'm sort of like the dark horse, So
good on you.
So, but it's great. Like it's a great thing to be doing though. It's from a fitness point of view, anything you can do, like as you say, keep your life going. Whether it be golf, golf is a bit too slow for me. I like tennis is a bit more active.
Well, the ball is stationary. It doesn't move.
It doesn't move.
I mean, if you've got with your bazooka forehand, the ball's coming at you, it's got topspin on it, it's twisting and turning, the wind's blowing it around. Now, to be able to hit that back within, again, a defined space is, to me, a real skill. But if the ball's lying there, you come up and have 4 practice swings. Now, the golfers won't like this, but to me, it's a stationary ball. It's not a lot of pressure on you, really.
Yeah, no. So I think so tennis. Love the game, and hopefully I'll play it as long as I possibly can. To be honest,
good on you. And I see parallels between that searching for those little increases in your performance, similar to your 10%. So if you're targeting a 10% income or total growth return, then you can dollar cost average when they're a bit low. Buffett calls it buying ice cream companies in the winter. You wait for a bit of a trough for various reasons, a temporary sort of lull, and you might buy some more, bring your average cost down, pull your return up, etc. So again, you're constantly looking, and your sharpness of mind, your physical well-being, all goes together.
It's the little signals, you know. It's when your opponent sort of drops their head down, and you think, okay, I've got him.
Right.
It's the same, you know. Investing, you're looking for little signals. You know, when's the right time to be investing? What's the right thing to be going into? And it takes, you know, and everyone has a different answer.
Yeah.
You talk to 10 people, you get 10 different answers. So you've got to really decide for yourself what the right answer is. But you learn.
Yeah, that's fantastic. So at the beginning of our session, and we'll close shortly, we mentioned your qualifications, but how did you move from a degree in economics, a degree in property, and then further studies into what you did? Did you want to become a chartered accountant and deal with debits and credits? Because that was your first degree. Then did you have an epiphany and decide, I want to be like mum and dad and move into property? And then how did you move into this space that you're in now, where you've been a chief executive, you've run major funds and things? Tell us a little bit about that.
I've been, I guess, fairly lucky, even from a young age, and my early exposure to property through my parents, that sort of said to me, property's a really interesting place to be. And I think I might have been 8 or 9. That there was a footy player, Gareth Andrews, used to play for Richmond, and he was in real estate, and he'd done an economics degree. And I thought, wow, you know, that's sort of separate. You know, I sort of looked at him more in a professional sort of line of sight rather than the typical real estate agent. And I thought, okay, well, that's what I should be thinking about as some sort of economics degree. And I sort of, from a young age of 8 years old, sort of carried that through. The trouble was I was always good at maths science. I did maths 1, maths 2, chemistry, physics, and did that because I thought I'd get my score up. And then I was fortunate enough to get into an economics degree at Monash. And it was a different world, because all the guys that I was sort of competing with in the economics degree had done accounting and economics through their school years. I knew nothing about economics and knew nothing about accounting. And but it learns you, you know, the thing about university, it's about a discipline again. It's about learning things and applying yourself and being able to sort of understand how the world works, really. And then that got me into I think I got off soon out of university. I got my first job offer was beneficial finance and financing, but I was just lucky at the same time I got a job offer from CBRE, Richard Ellis back in those days. And I think the beneficial finance job offer was $18,000 a year, and the CBRE, they said $30,000 plus bonuses if you do some leasing transactions and other bits and pieces. So I thought, I'll take the money, and did a cadetship at CBRE. Then someone there said, you should be doing valuations. I then went and did another nighttime study to do my valuations degree, and they then put me into valuations. Because I'd done accounting, they gave me all the difficult properties to value, so I ended up doing things like hospitals, nightclubs, retirement villages, accommodation hotel, all the difficult stuff. Went into this sort of more specialised unit, and that sort of gave me exposure to really about trying to work out how do you value, these specialised things,
very important,
and very broad exposure, and trying to understand the underlying businesses, how the businesses operated, and the occupancy levels, and all that sort of thing. So that gave me the early exposure, but. And then in the early 90s, I then went into funds management with it's called Heine Management Limited, Michael Heine, who, and I was sort of there for quite a few years until he sold the business to ING. And then he went off and then
did net wealth
and made, that's been a strong success story. And I think his son's also in the business as a CEO. So, but I then, in the property industry, I had a brief moment in corporate real estate working for Kerry Stokes at Channel 7, going through their analog to digital conversion across their business, which was a very interesting time. And but worked out quickly that I wanted to be back in the funds property industry, more general property industry. And that's where I've been my whole life. And these days I do a bit of consulting, non-executive director of a couple of companies. My old listed company, Arena REIT's still doing very well in the childcare and healthcare space. Big investor. I'm still a top 10 investor there. And very happy with that investment to this current CEO there, very comfortable with him. So I've just been fortunate in my life a little bit to have all those things carry through. But always looking for the angle and the innovation. And this is part of the problem. And this is why I like some of the consultancy roles that I'm doing at the moment, because you're looking forward and sort of thinking about artificial intelligence, what that means for the property industry, what does it mean for the office market, what does it mean for the retail market, and people wanting to invest money into these sort of sectors. And it's not easy. No. It's not easy.
Well, thank you. Now, you've still got a sore elbow, is that right?
That and a bit of a back, still
a back.
a niggling
the other day,
niggling back issue. But
well, as soon as you get those fixed, let's get back out there, because I enjoy our little sort of cross courts and down the line rallies and
what
up to 11 and all that and so forth. So look, it's been an absolute pleasure having you in.
Thank you. It's been a pleasure being here.
Yeah, I hope you enjoyed it. So,
good stuff.
Thank you very much, Bryce.
Good stuff. Thank you.
Bye.